Very good morning. Very good morning. So, welcome back again in the editorial analysis series. Audio video all clear? So, today we have, as you must have seen the thumbnail yesterday as well as today's newspapers covered, right? Very good morning, everyone. So, we have all the newspapers from yesterday and from today covered in the editorial. So, today you don't have any relevant article. You don't have any finance or economy related article in all of the newspapers. So, I'm covering all these, Indian Express, Hindu, Business Line, Business Standard, Mint, Economic Times. So, there is no such relevant article. So, what we have is from yesterday's newspaper, and this is, I think, from Mint, I picked it up. This is another very important news regarding your financial market or a very important decision from the side of SEBI. Okay, as you must have seen the thumbnail, it is regarding credit default swap being allowed, buying and selling of CDS being allowed to mutual funds, right? So this is the news. It is somewhat technical. It has financial jargons into it, but I will try to make it easy for you so that you understand each and every concept and what impact could it have into Indian bond market or say corporate bond market, into mutual fund market, all these things, right? So stay very focused in today's analysis. It is going to give you a lot of concepts today. I am telling you. You will get to know n number of finance related jargons and concepts, okay, and the analysis too. So let's start. The title, as you can see here, is MF's trade in credit default swap a good move. Okay, how this decision of SEBI is going to be a good move for the MF here is your mutual funds, right? Now, as you can see here, a move towards credit default swap. You all know what are mutual funds, right? You know what are mutual funds. So mutual funds, basically they pool the investors' money. Mutual funds, they invest collectively. They pool the investors' money. So this is how they share the risk basically, right? And the amount also gets increased when you pool the money and they collectively invest. So these are your mutual funds, isn't it? You all know what is mutual fund. Now this news is, what is the news? Let's see. First, see what is the news. What is the news? So the news is that the Securities and Exchange Board of India, SEBI, in a landmark decision, has proposed a transformative change that has potential to revolutionize the bond market, which could revolutionize the Indian debt market or bond market, right? That could revolutionize the Indian debt market landscape by permitting, so what is the news? Permitting mutual funds to actively buy as well as sell credit default swaps. So the news is SEBI has allowed mutual funds to actively buy as well as sell these credit default swaps. Now, what are CDS? What are the underlying benefits? What is the concept of CDS? We will try and understand everything. Okay. So, but let me just give you the background of this information. Yes, it is one of the factors in crisis. So, let's try to understand what the author has to say in beginning. Then we will look into what are CDS, who can buy and sell them, which are the authorized entities for this purpose, right? So stay tuned. First thing, the news is clear. Now mutual funds can buy as well as sell all mutual funds for all purposes except liquid and overnight funds. I will tell you everything, right? So they can buy and sell, actively buy and sell the credit default swaps. Before understanding the concepts, let's read these lines as well. It aims, now what is the aim? Broadly, the aim of this decision of SEBI for this decision is to infuse dynamism into the market. So here your mutual fund market, your debt market, bond market, all are being talked about. What is debt market? When we refer to debt market, it refers to all your debt funds. Debt funds, the securities which you invest, like bonds, bills, which you invest in, right? So they are like debt raising instruments. So debt market deals with your debt raising instruments. You all know bonds are debt raising instruments. They are issued to raise loan, to raise debt. Understood? So basically via this, SEBI wants to infuse dynamism into the market by enhancing liquidity. So I will explain these benefits to you. You will be able to understand these benefits once you understand the concepts. I am just reading in between the lines. I'll again come back to these benefits, okay, so that you are able to relate to them after understanding what it actually is. So to provide liquidity, improve risk management tools available. So this is basically a risk management tool only, okay, available to the investors. Foster development of deeper and more robust corporate bond market. So here SEBI aims to develop a robust corporate bond market. How it will do so? We will come back to this point after understanding what a CDS is and how is this mechanism going to help mutual funds. Okay. Now moving ahead. SEBI aims to align Indian practices with those in the developed markets. Another objective of this decision by SEBI is we want to align our practices with that of the developed world, developed markets. They are having CDS as an integral part into their finance system or debt markets, right? Where CDS trading is an integral part of their financial risk management. So financial risk management process there includes CDS as a very integral part. So we want to align our practices with that of the international practices going on. First thing. Second, introduction of CDS trading for mutual funds also raises concerns regarding the complexity of these instruments, potential speculative activities, and we need to have stringent measures to protect the investors. So broadly here, it is just an introductory part. The author is saying that this is the news. Now, what is the aim of SEBI? It is a complex process. It has both pros and cons. And India wants to align its practices. SEBI wants to align these practices with that of the international market. Right? This is the thing. We will come back to all these points. Let's first try to understand what is the news talking about. What is this CDS? What is the mechanism, right? Then you will be able to understand what is the aim of SEBI behind introducing or behind taking such a decision and launching such a move. Okay? Now, so basically, what is a credit default swap? You know what are swaps? Swaps are exchanges, right? So CDS, first let me tell you in a very simpler terms, CDS is basically risk management tool. Credit default swap. If there is any default on the credit, which the mutual fund has invested into, so it will provide an insurance to the mutual fund against that default. Now, why is it swap? So, via CDS, mutual fund is shifting the risk to a third party which is not involved in that transaction. So, let's try to understand this with help of an example. Then I will be coming to the proper technical definition of CDS given as per the RBI's website. Okay. First, try to understand this. You have this mutual fund. This is your, say, mutual fund company. Okay. There is a mutual fund. Now, mutual fund invests in several bond securities, in your corporate bonds as well, in government securities as well. Right? So, you have this mutual fund. Try to focus on this example. Now, suppose it has lended to a company. Suppose this company has issued a corporate bond, okay, corporate bond. So it has issued a bond, Now you all know what is a bond. Bond is a debt raising instrument, right? So the person who buys the bond is actually the lender. So mutual fund has bought this mutual fund has bought this bond. Now when the mutual fund had bought this bond, it has given money to this company, isn't it? So it has basically lended to this company, and this company has borrowed from this mutual fund. So investing in bonds is like giving money to them, lending money to them, right? So it has borrowed. Now borrower, this company, against this corporate bond can default. You all know, borrower can default. There is a possibility. We are not saying that all the borrowers default, but it is the case that borrower can default. Okay. So there is a risk that this mutual fund does not receive its money back. Yes or no? So there is a chance of default here. Now what is this CDS? It comes into place. So we have something called CDS. This is your credit default swap. Okay. Now there are entities which are allowed by RBI. We will look at all the entities also who can issue them. Okay. Who can sell them. So there are entities entitled, authorized by RBI or by SEBI. Okay. RBI and SEBI both will be looking into different aspects of this. So the regulated entities as allowed by RBI will sell the CDS to the mutual funds. What will they be? They will be a financial derivative. What is a financial derivative? Financial derivative is a financial contract. Okay. So they are like derivatives, contract deriving their value from the underlying asset, which is here this corporate bond. So now this seller of CDS sells this derivative, this contract to the mutual fund. So mutual fund buys it. Now when it buys it, it gives regular payments at regular intervals, like premium, okay, like insurance premium. So it will pay premium. Who will pay? Mutual fund. Mutual fund will pay this premium to the seller. The seller will in turn provide security against this loan in case this corporate bond issuer, that company, defaults. So the seller will give it the entire money which has been lost. It will, the CDS seller in return of these regular premiums, against these premiums, will ensure that in case of a default, it will pay back the money to the mutual fund. So this is how it sells the CDS to the mutual fund buys it, and the risk is shifted. Now remember, risk is not eliminated or averted. It is just shifted from the mutual fund to these sellers. This is what the CDS mechanism is all about. Now these sellers can be mutual fund as well. They also can sell, they also can buy. Buying and selling simultaneously allowed. Yes. So it is an insurance policy only, securing the money of the mutual funds, securing the funds available with the mutual funds. Okay. So it is providing liquidity and security to the mutual funds. Now remember, what if there is no default? What if there is no default? Because there is a chance only, we are not sure. So suppose this company does not default. In that case, this seller will earn profit, will earn money via these premiums paid by the buyer. And in particular typical terminologies, jargons, as per RBI definition, this seller is known as protection seller and these buyers are known as mutual funds. These buyers of these CDS are known as protection buyers because these are indulging in buying and selling of something which is providing you protection against the default, right? So protection seller and protection buyer, we call them as per RBI terminologies, RBI's definition. Understood? Jargons are basically, typical words which are subject specific, which the layman does not understand, which are not there in the common parlance, common language, common communication, right? Yes, it is one of the swaps, okay? One of the swaps. And jargon, as I told you, the typical words related to subjects, right? So this is the entire process. Now, if there is no default, the seller will earn, but the mutual fund will lose. So if there is no default, seller is not going to pay anything. Then why will be the mutual fund buying these from these sellers? Because the loss which happens to the mutual fund in case of no default is less than the loss if happens in case of default. So comparatively, having less of loss and being secured is better than losing a lot of money without security. This is the point. Please let me know, have you understood this CDS mechanism now? Yeah, that's why this is a risk management tool. Let me know, have you understood everything so that I can proceed with the analysis now? Everyone, okay? Understood? Good. All right. Clear? Now coming to the definitions and all those things. So here you can see what is credit default swap. Credit default swap is a financial derivative. As I told you, it is a contract, okay, that acts as insurance. It is acting as an insurance to the mutual fund, right? So acts as insurance against the risk of a borrower defaulting on their debt. So who is the borrower? The bond issuer is the borrower. And the mutual fund, as we have seen in the example, is the lender. So in case borrower defaults, it will act as insurance against that risk, right? Now, so this is a general definition. This definition, this bigger one, you need not be afraid of this, okay? Need not be afraid of the size of this definition. It is very simple. It is directly taken from the RBI's website. So it is the most authentic definition which you can have regarding CDS. So let's try to understand this. Now, as per RBI, credit default swap, CDS, means a credit derivative contract, again a contract as I told you, in which one counterparty, which is your protection seller, as I told you. So let me take this red pen because it is black, so red will be more clearly visible. Okay, so counterparty, between one counterparty, which is protection seller. As I told you, the seller by RBI is termed as the protection seller. So the seller is that entity who is selling the CDS, right? So we call it a protection seller. Commits to compensate the other counterparty, which is the buyer, which can be your mutual fund, right? Protection buyer. Compensate that other party for the loss in the value of an underlying debt instrument in which the mutual fund has invested. So if there is any loss, that seller will compensate it, okay, resulting from a credit event with respect to reference entity in return. Now, what the seller will get in return? Premium paid by the buyer, paid by the mutual fund, as I told you, right? In return, the protection buyer, the mutual funds, they make periodic payments or premiums for this contract to the seller. They will be paying premiums to the protection seller until the maturity of the contract. By what time? Until the contract matures or until the credit event arises, whichever is earlier. So until the maturity of the contract or the credit event, whichever is earlier. Now, this is a bigger definition, but you have understood everything, because that's why I started with a simpler example, so that you can cope up, you can understand these definitions, right? Now, there is a word here, credit event. So, RBI is saying that the buyer of these CDS, protection buyer, will pay the premium until either the maturity is there of the contract, maturity arrives, or the credit event arrives, whichever is earlier. Now, what is a credit event? Anyone knows that? What is a credit event? So, credit event as defined by, credit event as defined by RBI is negative change in the borrowing capacity for the payment. Credit event is what? Okay, let's do not erase this example if we want to refer to it again. So, negative event. What is a credit event? Credit event means when there is a negative change in the capacity of the borrower to pay back the money. So now there is a chance of default. This term has been termed as a credit event. Okay, that's why I told you at the beginning of the analysis, there are a lot of financial terms and jargons being used in this analysis. You will get to know everything. So this is a credit event. Now, if credit event occurs, that means the borrower is unable to pay this thing, the buyer will stop paying premium, it will receive the compensation from the protection seller. Understood? Right? So, whichever is earlier, either the contract expires or matures or the default happens. After that, if default happens, the mutual fund will get the compensation from the seller. Right? So, this is the third party managing the risk. You have shifted your risk on the seller, and that seller has taken the risk in against some premium payments, right? Periodic payments. Yes. So, when company pays back the entire thing, then also, but company will pay back, that contract will be designed in such a way that it coincides with the maturity period of the loan as well. Understood? It will be designed in such a way. Okay? Alright. So, now clear? So, this is the definition of CDS given by your RBI. Okay. Now, just another attempt to define it for you. Protection buyer of the CDS makes regular payments, premium payments to the protection seller, who in return promises to compensate the buyer if the underlying debt instrument defaults. So, if there is a default, you will be compensated by it. This is the thing, right? Now, so this is what CDS is. When we are saying that there are sellers and buyers of this, so mutual fund can be the buyer and seller as allowed by the SEBI. So this is very clear, right? Seller will not default. Seller will not default. Okay. These sellers are the entities authorized. They will not default. Okay. So who can be these sellers and buyers? So first thing is very clear from the information only that these are allowed for mutual funds. So mutual fund can be a buyer of these contracts, these CDS, or it can be a seller as well. But apart from mutual funds, who all can be these protection sellers, who all can issue these CDS is another important topic, right? Who are authorized to sell these credit default swaps. So who all can be the protection sellers to sell the CDS? You can see here that market makers and non-retail users. So the term used here is market makers and non-retail users. These market makers and non-retail users are allowed to be the protection sellers for the purpose of CDS. Now, who are they? Who are these market makers? Who are these non-retail users? So market makers, basically this term market makers is used for all the entities who can buy and sell these products. Okay. So it is referring to such entities who are allowed special, they are allowed to specially buy and sell protection. As you know, market makers, these are such entities who are involved in risk management. They can buy and sell these protection measures, protection contracts. One of them, which is CDS. These are your market makers, right? Protection from or to users and other market makers in order to provide liquidity to the market. So they are these entities indulging in the buying and selling of such contracts, such protection, such risk management tools. These are your market makers. But apart from market makers, you have certain non-retail users which are allowed for this purpose. So now we will be looking at the list of all institutes, entities which are allowed to sell these CDS in India. Right? So the following entities shall be eligible to act as market makers and non-retailers for this purpose. First, let's look all the market makers which are there. Who all termed as market makers, as I defined it for you, can be the protection seller for CDS. Now let's see. So this is the list taken from RBI website, right? This is the list. You can see here. Following entities shall be eligible to act as market makers in credit derivatives. So these will be allowed to buy and sell these protections, or to sell these protections. Understood? Which are these entities? You can see under market maker category. Scheduled commercial banks, okay, but except small finance banks, payment bank, local area bank, regional rural bank. So you can have scheduled commercial banks as the market maker or the seller, protection seller for CDS, but excluding small finance bank, payments bank, regional rural bank, local area bank. They cannot be the protection sellers because it would be riskier to include them. Getting my point, right? So first is this. Next, NBFCs can be there. Non-banking financial companies can be there working as sellers of the CDS, which will include your housing finance companies, okay, with a minimum net owned funds of 500 crores. Housing finance companies with a minimum net owned funds of 500 crore as per the latest audited balance sheet, okay, and they will be subject to Department of Regulation guidelines of RBI. So NBFCs can also be there given certain conditions and capital requirements. Clear? Next thing, standalone primary dealers. Standalone primary dealers can also be the protection sellers for CDS. Now, what are these standalone primary dealers? Standalone primary dealers are generally NBFCs, which are subsidiaries of these scheduled commercial banks. Okay, so they work as an NBFC only, but they are subsidiaries of these scheduled commercial banks. Understood? So these are your standalone primary dealers with a minimum net owned funds of again 500 crore as per the latest audited balance sheet and subject to approval by the RBI. Next, your export import bank can be the seller. National Bank for Agriculture and Rural Development, Nabard, can be the seller. NHB, National Housing Bank, can be the seller, and SEBI, Small Industrial Development Bank of Industries Development Bank of India, can be the seller as well. Right? So these under market makers categories are the authorized sellers by RBI. Or say this information has been taken from RBI website, so you can rely on all these names, right? Have you understood all these, all the list, this entire list, all these names, right? So first, this is a category who all can be the protection seller. Now another category, okay? apart from market makers, apart from these market makers, there are some non-retail users who are also eligible to work as protection seller, to act as protection seller for CDS, right? Who are these? So non-retail users, they are termed non-retail users. Apart from them, everyone will be retail user, right? So these are your insurance companies, they can also sell. Pension funds can be there. Mutual funds, again I told you, mutual funds तो है ही है उसमें, right? They are allowed to buy as well as sell the CDS. But apart from mutual funds, you can have insurance companies, you can have pension funds, you can have alternate investment funds, then you can have foreign portfolio investors as well, which are registered with SEBI. You can have foreign investors as well. Remember, foreign portfolio investors, but those who are registered with SEBI. No, they are not included, okay? Only these are included here. Whatever list is in front of you, they are authorized to issue the CDS and act as protection sellers. No, as per the RBI website, they are not there in the market maker list. NABFID is not there in the market maker list, right? It is not there in the list so far, okay? Yes, it is like DICGC insurance only, but it is not directly paying you the insurance, right? It is a way different. It is including the third party. It is shifting the risk on the third party. So, understood? All these will be eligible for protection sellers, for being protection sellers. The names given to you are only the are only there as per RBI's website, okay, as of now. So this is the thing. Now moving ahead, is it first time? So now the question is it first time that we have this kind of risk management tool? No, we had this earlier. It is now, earlier it was limited. They were not allowed to sell, they were only allowed to buy, and that too for fixed maturity plans. Getting my point? It is now that the scope has been expanded by SEBI. So now mutual funds can sell these CDS as well to one another. They can buy as well for variety of plans apart from fixed maturity plans. Earlier it was restricted to fixed maturity plans, right? So currently, Currently, Indian mutual funds are permitted to buy CDS only for hedging purposes, reducing the risk, right, in fixed maturity plans for a fixed tenure. So, presently they were allowed to do that, but it was limited. They could only buy, and that too only for fixed maturity plans. What are fixed maturity plans? The investments done by mutual funds in those securities and bonds which have a fixed predetermined time period, fixed tenure, right? For example, your T-bills, okay, bonds, they have a fixed period, isn't it? So it was only allowed for a fixed maturity plan. Now what is the change? This proposal, this new proposal seeks to expand this scope, allowing all mutual funds to buy CDS as well as sell, okay, buy CDS as well as sell for all schemes, all plans, excluding two. So now for all plans you can buy and sell these, excluding two, okay, for all schemes except overnight and liquid funds. Except overnight and liquid funds. Now what are these two? So I have explained you fixed maturity plans. You have understood, right? What is a fixed maturity plan? So they have a fixed date, lock-in period, like your T-bills, bonds, right? Now what are these liquid funds and overnight funds? So buying and selling of CDS is not allowed for overnight funds and liquid funds. Otherwise, in every fund now mutual fund can buy or sell these CDS. Right? So what is this overnight fund and liquid fund? overnight fund, as the name suggests, these are investment which mature in one day only, okay. So they have the maturity period of one night, overnight. The next business day, it gets cleared, right? So it is your overnight, single day. So it is the most liquid one. It is the most liquid one. Yeah, like call money. So what are these instruments? You have the CBLO, collateralized borrowing and lending obligation. This is one of the tool which you can understand is there for overnight funds. CBLO, very important money market instrument. Very important money market instrument, right? Collateralized borrowing and lending obligation. What are these CBLOs? These are also your debt funds, debt raising instruments, but it requires security against it. As the name suggests, collateralized borrowing. So you need to borrow against a collateral provided. Who issues these CBLO? So you have CCIL, Clearing Corporation of India Limited, India Limited. These are there with the CCIL, okay. Clearing Corporation of India Limited. You have the CCIL. CCIL is basically the clearing corporation. What are these clearing houses or corporation? They enable the transaction. They inspect the transaction and then let it happen. So Clearing Corporation of India Limited is responsible for settling these payments, allowing the settlement of these financial payments in your financial markets, which includes your call money market or money market instruments, all the money market instrument payment settlement, okay, facilitated by CCIL. Then you have your foreign exchange as well, government securities as well. So all these financial transactions, settling and clearing is done by your CCIL, Competition Commission, Clearing Commission of India, Clearing Corporation of India Limited, right? So it is somewhat similar to Competition Commission. That's why it was just a slip of tongue. So Clearing Corporation of India Limited, remember, Clearing Corporation of India Limited. It issues these CBLOs. They can be bought from CCIL, okay. What are these? These are again debt raising instruments for like overnight. So overnight maturity, you need to put security against it. What can be that security? As authorized or permitted by the CCIL, presently these are your government securities, including your treasury bills. So you can put the treasury bill as collateral and then you can borrow. So these are your overnight funds. Now, why overnight funds are not included in this? They are secured. You are putting some security against them, and that security is T-bill, which is inherently secured. Understood? Getting my point here? Yes or no? So they are not included in this CDS mechanism. They are secured. You keep security against these borrowings, CBLO, overnight funds. Right? Next, liquid funds. Liquid funds. Now, what are these liquid funds? Liquid funds are again less liquid than the overnight. These are also for short term. So they have higher liquidity. Generally, liquid funds, as per SEBI regulations, SEBI's norms, 91 days maturity period you can invest in as liquidity funds, okay, liquid funds. So these are generally having the maturity period of 91 days. So you can have these T-bills, treasury bills issued for 91 days, 182 and 364. So you can invest in T-bills as liquid funds. You have commercial papers, right? What are commercial papers? Commercial papers are also unsecured debt instruments. Unsecured they are for short period of time. They can be issued by your primary dealers like banks and all financial institutions. So yes, you can invest in commercial papers or short term T-bills 91 days in liquid funds. These are secured and more liquid. That's why not covered under CDS. Although commercial paper is unsecured, but since they are for short period of time, there is lower risk. Okay, risk increases when there is a longer tenor of the loan. Yes or no? So understood that this proposal has now been expanded, excluding overnight and liquid funds, which I have explained you, all the instruments which is there in the overnight fund, CBLO, the commercial papers and like this kind of things in liquid funds. Okay, for fixed maturity you can have certificate of deposits. They are for fixed period and fixed amount issued by banks and selected financial institutes, right? Certificate of deposits you invest in, they have a lock-in period. So that is a fixed one. So we have seen all these examples. Now, have you understood till this point? Understood this entire news, the entire mechanism, how will it work, right? Yes, the scope of MF has now been expanded and the instruments on which these CDS can now be used has also been expanded. Clear? This question which you asked, okay? Understood? Now, so this is the entire picture. Now, moving on to the further analysis. This move aligns with RBI's 2022 revised regulatory framework for CDS, aiming to develop the debt market further. So RBI has also tried to develop the debt market further. So it is in line with RBI's framework as well. Okay. Now, what are the pros and cons? Since now we have understood every concept there, we can analyze what are the challenges, what are the benefits of this decision by SEBI, right? This is the analysis part. So first of all, discussing the pros, okay, what are the advantages, the benefits which will accrue out of these decisions, right? So first says, the author says that SEBI aims to increase trading activity and liquidity in the corporate bond market. It will increase trading activity and liquidity in the corporate bond market. Why? Because now you have something to secure, your investments, your funds. So you will be able to indulge into higher risk related transactions as well, because you have third party to shift your risk upon them. Isn't it? So trading activities will be better, and you all know that corporate bond market particularly has risks. So it will provide liquidity and more trading activities and security in the corporate bond market. Yes. Okay. Next, this could lead to more efficient price discovery. Now you have third party involved. You have proper risk management. So price discovery, deciding of the price in the market of these bonds can also be more proper, more inclusive of the inherent risks underlying in those contracts or assets which you are investing in. Understood? So proper price discovery and broader range of investment opportunities for investors. Now you can take the risk of investing into risky instruments because you have security for that. So it will offer you broader range of options to invest into. Clear? These are certain advantages. Next, further, mutual funds can utilize these CDS to hedge, to reduce their risk, their credit risk exposures, reducing the impact of potential defaults on their portfolio. So again, it will help them manage their risk involved in their investments. Clear-cut benefit, isn't it? Next, this could enhance the stability and resilience of the mutual fund industry. Once you have proper risk management tool, that would, and you have proper liquidity, it ensures you will have liquidity. So your market will be resilient. No doubt about that, right? So it will provide resilience to the mutual fund industry or market, also resilience to the corporate bond market. Right? Moving ahead. In addition, increased participation from mutual fund could lead to deeper corporate bond market as well. Now, mutual fund, given the risk, hedging of the risk facility, can invest in more risky assets, right? More risky bonds. They will be participating more because now they know they have something to not to worry about. There is a third party which will compensate them if they have bought the CDS, right? So they will trade more. It will provide corporate bond market resilience or vibrance. Understood? Now, so far we have discussed the pros, the advantages of this decision, which could be there, okay? So, what is this question? Since MFs will be paying premium for protection, then can we say in future expense ratio will also increase? No, they have to give this premium irrespective of the default probability. That's what I told you in the earlier analysis only. They will give the premium whether the person defaults or not. They will have to give the premium, and if default does not happen, it will be their loss. But at least their loss will be lesser than what could have been if they would not have bought this CDS. This is the thing, okay? That amount will be fixed premium, okay? It will be fixed, and if default happens, they will get the compensation of the value, nothing extra, nothing extra. Understood? Yes or no? Okay, so we have discussed the pros. Now let's discuss the cons. While CDS are primarily used for hedging, now the author has highlighted that although we are using them for risk management, there can be malpractices as well. You see, they happen in everything, right? They can be used for speculative purpose as well. They can also be used for speculative purposes. Unnecessary speculation of default. Even if there is no chance of default, they might speculate, they might sell them, mutual funds will buy them, seller will earn money, mutual funds loss of premium amount. Getting this point? Also, it might be the case that these funds are buying these CDS for the bonds which they didn't even buy. Understanding or not, right? So, they might bond these CDS for the bonds which they didn't even buy, entering into some another kind of contracts with these entities. I don't need to clearly say about that. I'm just giving you a hint. I hope you are understanding this, right? So it can happen. They can have mutual benefits out of it as well. So stricter regulatory framework is allowed to ensure that malpractices do not corrupt the scope of this decision. Are you able to understand this, right? Next, so unregulated speculation could lead to market volatility as well. So regulation is required. You need to regulate this entire mechanism. Otherwise, that unregulated speculation will lead to market volatility instead of providing it with stability and resilience. Right? Next, SEBI needs to ensure adequate investor protection mechanism. So you need to ensure certain protection mechanism, information disclosure mechanism, right? You need to have data repository so that everything is transparent. These are not misused for their mutual benefits. Mutual funds do not use there for their mutual benefits, right? So remember this. Also the author says clear disclosures and investor education is essential. Clear disclosure of the information related information, so that every investors, the seller, the buyer, everyone knows about all the thing which is there regarding the CDS, right? Next, like in US and Europe, so here the author has compared it with the international standards. In US and Europe, CDS trading is well established, but they also have a well established regulatory framework for that. Okay, plays a crucial role in risk management. However, regulatory framework there are robust. So they are working properly because they have simultaneous regulatory framework as well for CDS with stringent risk management requirements and investor protection measures. So investors are protected against any malpractices, false leading information. So you have to have proper robust regulatory framework like these countries, then only you can integrate them into your risk management process and you can get benefit out of them, right? This is the thing. Then next, way forward. So the author suggests what can be done further. SEBI's proposal marks a significant step. Author acknowledges the fact that this can prove to be a revolutionizing step, but we need to do something. The success would depend on several factors. What are these factors? First, SEBI will need to establish a comprehensive regulatory framework, as we have discussed. You need to have a regulatory framework in order to avoid leakages from the system. Getting my point? Second, SEBI should focus on investor education as suggested earlier. Investor education, proper disclosures of information, right, which are crucial to ensure that investors understand the risk. They should understand how much risk is involved, how much premium should they pay, so that the sellers do not capitalize upon that lack of information and benefits of CDS and make informed investment decisions, so that they can make informed investment decisions, right? So this is suggested by the author. Also, developing robust market infrastructure. You have to develop infrastructure as well for these transactions to take place. You need clearing houses, right? You need clearing houses. So developing a robust market infrastructure, including trading platforms. You need to have these trading platforms on which platform will it be traded? CDS. You need to have clearing houses. Who are the clearing houses? They act as intermediary. They will act as intermediary between these sellers and the buyers. They will inspect the transaction and then allow it or facilitate it. So inspection by clearing houses is also necessary. Then data repositories. You should have a repository of data related to this entire mechanism. Proper disclosure of information should be there. Understood, right? Which are essential to facilitate efficient and transparent CDS trading, so that the CDS trading happens efficiently and transparently. Now the author says this decision has potential to revolutionize this market unless, so revolutionize this market given these proper regulatory frameworks are implemented. Now tell me, all of you, have you understood what this news was? Although it was very technical and complex, sometimes it becomes difficult to understand such kind of decisions, but this was the best possible manner I could explain it to you to make you understand, right? So have you understood this entire thing? Yes or no? Understood? Very good. Now coming back to the initial slides. So these are the opinions of the author, right? What the SEBI looks, as the CDS trading in relation to CDS trading, what is the aim of the SEBI which we have discussed? Now let's relook those points, then you will be able to understand. So we have these points. So the aim of SEBI here to infuse dynamism into the market by enhancing liquidity. So liquidity is enhanced, obviously. You have safer funds now, so they will be available to you. If it defaults, even then you have third party to pay you. So liquidity ensured, first thing. Then improving risk management, of course. Then fostering development of deeper and more robust corporate bond market, of course. So it will provide resilience to both mutual fund market, and that resilience in mutual fund market will be reflected in corporate debt market or bond market or debt funds, right? Next, SEBI aims to align these practices happening internationally, as we have seen the example of US and UK, right? So we have to have international standards parlance as well. This is the thing. Introduction of CDS trading for mutual fund raises also concerns regarding there. We have discussed what all are the concerns, what can be the negative side of the CDS trading. So we have seen the pros as well as the cons, right? So there are concerns, but still, given this decision by SEBI, it can be revolutionizing, pumping in funds into these both kind of markets, mutual fund and the corporate bond market, reducing the risk involved, proper risk management. What you need to have is proper infrastructure and proper regulatory framework. If you could do that, if SEBI can do that, it can be a transformative decision, revolutionizing decision for India's mutual funds and corporate markets, debt funds, all these related securities. I hope you have understood these things, the news, that who are allowed, who are not allowed, what is not allowed, all these things. I hope this is useful for you. That was it for this analysis of today, and I think no one will give CDS for Adani considering the amount he takes. No comments on Adani's situation. You know, it is very fluctuative. I would not comment on this. With a good regulatory mechanism, benefits, yes, benefits can be reaped. Very good. Okay. So, any doubts regarding today's session? Any doubts? Any questions? So, no doubts. I hope it helps you. And that was it for today. Thank you so much for staying there, and I will see you in the next session. All right. Thank you so much. If you have understood it, then I'm happy. My job is done then. Okay. My job is not done, after 1 hour completing the lecture. It is done when it is delivered to you. Not on the completion from my side, but if the delivery is proper, if you have understood what I have delivered, right, then it is okay. All right then. Thank you so much for staying so focused, so interactive. I'll see you guys in the next session. Till then, have a good day. Thank you.